Hello, everyone, and welcome to Voice Like a Lion podcast. I'm your host, Stephen Pemberton, and today I'm so fascinated with this gentleman and his story, and I know that you guys are going to love the journey that we go down during this conversation. So, this is Alex Golod. He is a results driven IT executive, angel investor, and a global technology sourcing expert with over 20 years in technology. So, Alex, welcome to the show.
Glad to be here. Thanks for having me.
Absolutely. So I know that we got introduced to a mutual friend, and you and this mutual friend, you share one thing in common, and both of you are angel investors. But I know that you guys do not do the same things in the same way. So take me back just a little bit. What got you interested in becoming an angel investor?
Well, of course, it's a long story, but I'll try to distill it into very few simple facts. I came to United States in 93, well, I would say over 30 years ago, as a very young man. And I was always fascinated by US, by the way business and entrepreneurship flourished in this country. And of course, it's called the land of opportunity for a good reason. I've been doing a lot of different corporate and small business entrepreneurship jobs, but I was always having this what I called investor streak. So one time came, I started investing first into the businesses I understood, closely related to my technology interest, closely aligned to that. And later on, about 8 years ago, when I what I call graduated from both corporate and entrepreneurship world, I thought I would like to build my portfolio 2.0, and that's what I'm doing for the last 6 or 7 years. Of course, with variable success. It's usually on paper until you realize your gains and losses. But what's important here is the fact that it's sort of driven for me by my investment philosophy, but also by what I call community spirit. There are a lot of young companies in US that needs to get off the ground, and it's not that easy, especially without money. The main problem for young and ambitious and inspiring entrepreneurs is simply the fact that they need money to succeed. Despite all our technological advances, it's very difficult to start a real successful business without money. Hence, angel investors come in.
That's thank you for taking me through that. One thing that I sit there and I was hearing you say is you were talking about startup founders and just how hard it is to get startups off the ground. And I do think that that is absolutely the truth. I mean, I am a startup founder, and for me, this is something that's been very interesting because I mean, we bootstrap everything. And when I sit there and I'm reading this book, it's called The Founders, and it talks about a real startup. We're a startup per se, but like real startups, big ones. This one was PayPal, and with PayPal, just listening to how much capital they needed to run a company that ended up becoming a $1 billion IPO, it's insane. And even, yes, we have AI, we have these different tools and different aspects of business, but capital is such an important one. So with capital being so important, how do you choose a startup to say, yes, this is the one that I'm going to invest my capital in?
Of course, we'll have our checks and balances and checklists and scenarios, right? But I personally invest in what we call in our world seed round. So it's past friends and family, past some initial traction that needs to be displayed for outside money to come in. I'm personally focused on what I call technology-centric B2B companies, where not necessarily having the same characteristics that consumer businesses. Apparently, there is the world beyond Silicon Valley borders, as we know it, despite popular belief. And there are a lot of interesting niches, right? There are a lot of things that need to be reimagined in this world. I'm particularly fascinated by fintech and insurtech industries that definitely require burning down some bridges and starting anew. I like advertising tech and educational tech. I also like the businesses that have an opportunity to create jobs and community to guys and attract type of scenario, but more so have ability to grow and flourish and expand and bring some value, of course, to other businesses, but and to to consumers as well, B2B2C model. Other than that, it's all over the place. It can be corporate gifting platform, or it can be something that what I roughly call media and entertainment, area, music tech. There are a lot of interesting developments in several industries.
The first time we talked, you mentioned that you don't just invest in the United States, you actually invest all over the world. So with you investing all over the world, do you see it? Well, honestly, this is my question because what do you see being the biggest difference between investing in an American company and investing in an overseas company?
Well, the biggest difference is probably risk factor, right? When you live in the States, you happen to know much more about laws. There is factor of transparency. You can ask and get much more information. In other countries, of course, we're dealing with different sets of factors, rules and regulations. Also, the fact that there can be legal differences. It can be, difference with currencies, right? So,
Yeah.
so when you invest in Eurozones, they mostly count everything surprisingly in euro, not dollars. The common denominator often is the fact that my portfolio companies, including global ones, have interest in US markets. It's not universal rule for me, but it's definitely a big plus because something has to happen in this country for the startups to succeed, right? So
Yep.
I'm not necessarily, completely out of startups where they operate in Europe or Latin, but definitely doing business in the US is a big plus. The other area where I'm quite active is immigrant community in North America. So in other words, that part of my investment dollars are allocated to immigrant founders. That's, in my opinion, that's one of those economic engines for US. It's of course supported by all kinds of statistics, but that's near and dear to my heart. Being myself an immigrant founder, I do like to invest in other immigrant stories, exceptional immigrant founders, as I said.
And I love that you do that. I remember when you mentioned that, that's one of the highlights of the conversation because, I mean, honestly, if we're honest, if everyone listening, if you are in America, you did not come from here. Like, at some point in time in your lineage, unless you are Native American, then you did not come from here. All of us are immigrants. And I think that that's something that we have to take into consideration. And I love that you're supporting the immigrant community because it really is it's the cornerstone of what America was built on. So for you being able to invest in those immigrants to help them have the same kind of successes or even more success than yourself, it's inspiring, honestly. And I'm very thankful that you're doing that because more of us need to get into that field to realize that none of us are considered quote unquote Native Americans. We just are American. That means at some point in time, we had family members come over here. I mean, for me, I'm Hawaiian. Yes, Hawaii is a part of America now, but that we're the youngest state. So that means we're actually annexed. So with being Hawaiian is until the annexation, if we would have come to America, we would have been immigrants. So I think that there's so much to say for what you're doing to support immigrants. And just going back for 1 second, this has been a question ever since I talked to another gentleman who was on this podcast. His name was David Spitulnik. And he went all around the globe and he would do these big corporate mergers and acquisitions. Is when you talk about overseas and you're talking to a company, how do you know? How do you know the different laws and regulations? Do you take the time to study it? Do you hire a lawyer from over there? It's like, how do you navigate those waters? And because if I came and just kind of like an example is if I was in Israel, let's say, and I had a company and I just learned the legal jargon of America, and then I came to you and I said, "Hey, Alex, this is my company. This is how we're going to approach America. This is the way we're going to do it." And you didn't realize that I had actually built my company incorrectly in Israel, and it was like against the law for me to run. How would you navigate that? I'm just very curious about it.
Well, to be honest, the world changed dramatically, and if foreign companies are trying to raise money from U.S. investors, both institutional and individual, it's more likely than not that they're already, incorporated in U.S.
Oh, okay.
That's where Delaware comes, in play usually. Most of them are part of US-based or global accelerators, incubators, other programs. And so they're not that foreign, you know what I mean?
Yeah.
The other way to operate it, because no, I do not hire a lawyer and I do not employ my own business lawyer for every single transaction. There are a lot of syndicates, right? Some of them are
Yep.
quite global. There are some laws and regulations. So in my case, I have one of my portfolio companies is fintech in Berlin, Germany, but they also incorporated in UK. So there are very specific UK rules and regulations how to organize the company, and they're one of the very few that are not incorporated in US. It's pretty clear cut. I also very interested in the region where I came from. I'm originally from Belarus. Not prefer, but definitely interested to invest in some companies in the region, what we call CE, Central Eastern Europe. So I have founders from Baltic states, from Nordic, from Ukraine, from Belarus, from Poland, but most of them do have presence, both legal and what I call human. They have some staff and some roots in US as well. So it's not necessarily that foreign, And of course, there are certain countries that, based on my own principles, I'm not going to touch. Probably don't need to spell it. It's I don't see much of flourishing startup ecosystem in North Korea or Iran, right? Put it mildly, right? So it's not that difficult. And once again, my portfolio is still US centric, of course.
So for me, like, with having extra capital, if I wanted to become an angel investor, I've wondered this for myself is how, because you talk about syndicates, how do you find syndicates? I've always just thought, do I just like walk into a store and say, "Hey, do you need money?" and just like trying to help the owner grow or something? I've always wondered, how do you actually pick someone that you want to invest in? How do you find these investments? How do you find the founders? Like, how do you go about doing that?
So in terms of beginning of any path, right, you need to learn, and learn is always good by example. In my opinion, there is this very famous, often quoted words by John Donne: "No man is an island," right? So the whole idea, and that's came to me a little later in the game, unfortunately, is the fact that not only no man is an island, lone wolf approach to invest in is sort of doomed. You're not the smartest person in the room. You don't want to be the smartest person in the room. Hence, you learn from more experienced investors. And one of the easiest way to get into investing is, of course, through syndicates. Very well-known syndicates are run by AngelList. Some of my co-investors and friends are syndicators. There are, of course, a little lower barrier of entry through crowdfunding platforms like Republic, which I really like WeFunder. But this is more of smaller dollar amounts, kind of getting started, so to speak. There are also several great programs. I'm a big fan of some accelerators. I used to work with several of them. Unfortunately, some of them got kind of hit very hard during COVID years. The whole idea of what we call batch cohort, when several startups come in to places like Boston or Austin or New York and accelerate their businesses with the help of mentors. And by the way, Steve Walsh, who introduced us, he is a great mentor for one of the most respectable accelerators, Techstars Boston, right? So this is great source for deal flow. This is great source to find co-investors. As I mentioned, accelerators, right? And then the other way, which is more of diversification, less of a risk, is to become LP slightly later on in your investment career for one of early stage VC funds. I'm LP with the fund in Boston called One Way Ventures, and they're called One Way simply because they do invest in exceptional immigrant stories. So it fits very well with my personal interest and with my personal investment philosophy. But I would certainly start from well-defined rounds in the companies that are slightly maybe late in the game, past concept stage, and also definitely diversify. If you invest in 1 or 3 or 5, the probability of success is quite limited. It's not necessarily close to zero, as some people say, but it's definitely not 50%. So between diversification and syndication, it's kind of easier to learn, in my opinion.
Okay.
And diversification means what I like about diversification, it has to be diversity of thought, diversity of founders, diversity of everything. So It's not just geographic. It's not just based on specific mission. If you don't have to have just mission on your investment criteria, but not only you improve your investment return, you probably improve lives of those startup founders. So it's kind of win-win.
Well, I actually love that theology because I've never thought of it. I mean, when I hear the word, I'm thankful that you jumped in and you were describing what diversification means to you. When people hear diversification, it's like, okay, I'm in fintech, but I'm also going to be over here in like healthcare, and then I'm going to invest in multifamily real estate. It's like, that's what you mean by diversification, right? And then you're saying, no, like completely diversify founders, diversify region. I love how you explain that. And I think it's really interesting because when I talk to angel investors like yourself or even venture capitalists, it's interesting to hear the way that you process things, because I wouldn't think of that. And I wouldn't think about, I'm going to diversify from founder all the way down. It's like, okay, I think of diversification. I'm just going to diversify my portfolio. I'll go get some stocks. I'll go do whatever. But I think what really fascinated me by something that you said was and it relates to what I've run into a few times when people try to pitch me, when they send me different things and I look at it, is you said it's like after certain rounds of funding is when you will come in and you will fund. And I think, why do you feel like it is? And I'll give you a real example. There's a gentleman came to me. He's been in the advertising business for 17 years, has a really good company in advertising, has done really well. But for some reason, he says that he started a SaaS company. And the way that he did that is he has this platform. And I looked at it and I thought it was interesting. But I discussed it with a couple of other investors, and we all kind of came to the same conclusion, which is he created a software, but if he just would roll that into his marketing agency, he would make more money on the marketing instead of trying to spin it off and create his own company, try to raise different rounds of funding, is just to keep it encapsulated in one big company that already has the credibility. It's already been around for over a decade and a half. And then if he needed liquidity, he could just sell off some of his equity, sell off some of the private equity. And I thought that's fascinating. But why do people want to create a company and get venture capitalists or get people like yourself to come in and fund?
Yeah, it's a very interesting question. So philosophically, not every company is created for venture capital, so for outside money, for capital infusion in general, there are tons of companies that somehow not in very precise term are called lifestyle companies. They're just simply not built for outside capital. In other words, as investor, I would consider very basic question: what would happen if I invest in this company? How they gonna take my money and run with it? What's really ROI? Do they know exactly where they're gonna place their bets? But there are tons of companies that can grow organically, that can grow through M&A. They can access new markets or new product lines without any outside capital. And as angel investor, as venture capitalists, we really have to understand the difference, right? So I personally bet on a jockey more so than on a horse. So founder is very important. But if founder is moving the wrong way, or the way that's not gonna make their venture successful, what's really different about those founders? They use this beautiful word called pivot. They can pivot in one area or another, the third one. So in your example, it's some kind of pivot as well, but not necessarily the right one. So it's, as I said, not every business really requires the capital. That's number one. Number 2 point, which I really like to make, is the fact that I do invest in early stage. So seed round is early stage for most of VC. Definitely private equity not going that way at all. But it's not necessarily that my interest as angel investor are truly aligned with VC. As we know, VC is built to have one round after another. Pretty soon, all letters of alphabet will be taken, right? It's Series A, B, C, D, etc. Right? And if you look at some of those very successful, at least financially, from financial standpoint, companies, they went through A, B, C, D rounds and they've been successful. But the exit is so far away. So if we invest a little earlier, I don't necessarily subscribe to the idea that my money, our round, seed round, should be the last one. But limiting number of rounds, limiting dilution, it's important for me. So I personally subscribe to the concept of early exits. So when not all companies are born unicorns, right? Most of the companies will never reach unicorn status anyway, and hence I'm looking at the companies that have an opportunity to grow to, let's say, 50 or $100 million range, which is perfectly fine for me.
Yeah.
But that's exactly not what VC is all about. Unicorns are not good enough for them. The valuation of $10 billion is what they call new unicorn. As of 5 years ago, considering inflation, it's quite clear, but that's not necessarily what I'm looking at in terms of my first question, right? VC's first question is really, they're pitching me something. Do they have a chance, even moonshot chance, to get to $10 billion valuation? That's not my question. My question is probably, do they have a chance to reach $100 million? Do they have a chance to build a team and build successful business? So different set of questions.
Yes. I think it's fascinating because even the conversation that I had with Steve is he talked about, because I asked him a question that's like, what's the difference between a company that exited for hundreds of millions and some that exit for less than 20 million? And he said it's really on the founder. It's like if the founder feels as if he said he had one founder that exited and they made $36 million. He said that company was going to where that guy was going to make $100 million. It's like, but how am I going to convince you to wait and hold on to grow it to 100 when you could take life-changing money now? And that's such a fascinating concept, because I think that there's more than even just a concept that's a moonshot that could go to the new unicorn and go to 10 billion. It's like, are you as a founder, When you are looking at for those founders themselves have to be unicorns, because most people are not going to be able to stomach the ride up to 10 billion. That's a long way. And I mean, I saw this on social media the other day. It was an angel investor talking about his time investing, and he said, actually, he was a venture capitalist, and he discussed venture capital, and he said that it took 7 years, that Facebook was 7 years no revenue. He said 7 years no revenue. It's like not no profit. It's they took nothing. Like they made nothing in 7 years. It's like, how do you run a business for 7 years without making anything? And then he said Amazon was taking a loss for 13 years straight. How do you take a loss for 13 years straight? The only way you can do that is if you have huge venture capital backing. And I think that is so fascinating, though, because now we hear about Amazon, they're $1 trillion company, and that's incredible. But it's like the ride, right? Because somebody asked Jeff Bezos that. They said, how are you evaluated at being a billionaire when your company is losing money every single year? And he said, that's one of the mysteries of the universe. But that's one of, I mean, even for him, he's a unicorn of a founder that you're willing to sit there and lose. But it's those behind the scenes things that you're sitting here and talking about that's enlightening me and helping me understand, and helping us as the audience understand what that looks like, how that works. For you, it's you're just looking for someone to go to 100 million and take an exit. A lot of times there's a buddy of mine that he helps e-commerce companies exit, and he tells them that it's like, grow your company to a few $1,000,000 a year, do that for a year or two, exit, and then just go do it again. He's like, stop trying to grow this thing to $1 billion company. He's like, just grow it, exit, take that capital, do something else. And I think so. What spurs you to look for those kind of companies? Why did you decide for early exits over the long haul unicorns?
That's definitely a legit question. It's not easy to answer because most of founders, to be honest, are ready to take an exit within $10 to $100 million range for the whole company, and those are, as you mentioned in your e-commerce example, those are normally good exits. Kind of surprisingly that people don't see this as slam dunk or home run, but there are tons of exits that happen in startup world that bring most of investors and founders, for that matter, between 2 and 3x. Those are really legit exits, right? If you can take those and recycle this money and help more young, new, ambitious companies, that's a big plus, in my opinion. And in all honesty, the probability of building unicorn is extremely low, right? And most of just even by talking to my colleagues, collaborators, co-investors like Steve, most of successful exits do happen within 100 or maybe $200 million range. So it's totally fine. On the other hand, I don't necessarily see much value, I would say financial value, in tons of startups that grow really, really big. They're no longer startups, but they sort of don't know how to make profit. We all know these businesses, right? It's most of on-demand economy, which we'll find by using it, right? We're perfectly fine with using Uber and DoorDash and Airbnb, etc. The slight problem with those businesses, as you mentioned yourself, they don't know how to make it profitable.
Yeah,
and that's kind of conceptually an issue, because most of businesses in society we live in, capitalistic society, right, are built to create profit. Somehow they're not. So that's really a difference. So there are tons of insurance companies that are 200 and 300 years old, right? Even in the US, surprisingly. Yeah. And they're good, stable companies, and there's really nothing wrong with them. Yes, they need to be probably burned down and reimagined, and that's why there are so many insurtech companies. The problem is legacy players still have an upper hand. So if you look at the history of insurance versus insurtech, legacy players versus new companies. Same with fintech. Is a very, very uneven road. I think it's the whole idea is variety. It can be both. There can be unicorns. There can be companies that grow into stable growth and become 50 to $100 million businesses that maybe even pay dividends. There are exits. There are so many roads that can be taken. Liquidity is important, though. So you need to realize liquidity sooner or later.
Yeah, absolutely. So, Alex, for anyone who wants to follow along on your investing journey, how would they follow along with you?
I would say the best way to connect with me and look at what I'm doing in the world is through LinkedIn.
I'll make sure to have that down in the description. And for the people listening, be sure to follow along in this journey, because if you're getting this much value and information just from the last 30 minutes, just imagine what you can get just by following along what he has going on. But before I let you go, Alex, I ask everyone on the podcast a similar question to this is, tell me a funny story about your investing journey.
Boy. Didn't expect this particular question. I don't know even about, it's not necessarily that funny, but it's more of, a little bit of lesson learned. Some of the stories and introduction and encounters happen in the place where you don't expect. I do travel a lot, and some of the most fascinating conversation, and sometimes they lead somewhere, either to new business, new investment, happen in faraway countries, in airports, airport lounges, inside the plane even. Sometimes you meet people and you either become friends or you collaborate with them and you stay in touch. You go out with them for like lunch or dinner and exchange notes. And I don't want to go into the area of hotel bars, right, where a lot of interesting conversation happen too. But like I said, I cannot come up with really funny story, but there are a lot of really great, fascinating encounters that happen when you travel. It's if you're intellectually curious, that's the way to go. Just talk to people.
Yes, that has honestly been one of the biggest growth areas for me, is just talking to more people, because everyone has a story and everyone's story is interesting. Everyone's story is unique to them. And thank you for being on the show. I appreciate you being here and just sharing all your wealth of knowledge with me and with our audience.
Thank you so much, Steven. Thanks for having me.
And to everyone listening, I'll see you in the next episode.